Welcome everyone to today's ECIPE webinar. What happened to the Draghi report, reclaiming European leadership for technology, innovation and growth? I am Oscar Guinea, Director at the European Centre for International Political Economy, and I will be your host and chair of today's event. I am thrilled to be joined by a fantastic panel of experts. Judith Arnal, Senior Research Fellow at CEPS, Elcano and Fedea. Daniel Gross, Director of the Institute for European Policymaking at Bocconi University, and myself, esteemed colleague, Fredrik Eriksson, Director of ECIPE. So we are going to debate European competitiveness and what the EU can do to become more competitive. We will begin with each of our panelists outlining the main ideas for around 7 minutes. Following that, I will kick off a round of questions. So Judith, over to you to start the webinar.
Thank you very much, and many thanks to ECIPE for the invite. And it's a great pleasure for me to be moderated by you, Oscar, and to share panel with outstanding colleagues like Fredrik and Daniel. So I will start by discussing one of my preferred topics, which is funding. One of the figures that caught more attention from the Draghi report was the investment gap, yearly investment gap of 800 billion euros, which has now increased, according to Draghi, to 1.2, 1.3 trillion euros a year. So the question is, how do we fund this, and are we on the good track to do this as per Draghi's recommendations? So the first point, I think that we all acknowledge that with the exception of some member states, namely Germany, who still have fiscal space and have indeed put forward a very ambitious investment and defense program, all other member states don't have fiscal space. So I'm thinking about France, Italy, and Spain, the other three large EU member states where public debt to GDP is above 100%. So basically, this immediately leads to the conclusion that according also to Draghi's report, around 80% of this funding gap needs to be met with private funding sources. So does this mean that we have a savings problem in the EU? No. If we have a look at macroeconomic figures, we see that lack of savings is far from being a problem in the EU. And a clear example of this is also our current account surplus. We export savings to the rest of the world every year. So the question is not about how much we save, but what we do with those savings. And if we have a look, for instance, at households' financial wealth, so we see that around 70% on average in the EU of this households' wealth is devoted to real estate. So households' wealth, 70% real estate, 30% financial wealth. If we continue zooming in into these financial wealth figures, what we see is that more than 30% of households' financial wealth is devoted to deposits, compared to around 12% in the US. And don't get me wrong, deposits are a very relevant funding source for our banks, but it's true that we could aim for better allocation of these resources, both from the perspective of the saver, so getting higher returns, higher yields, and also in terms of funding innovative projects in the economy. So what are the levers that we should be thinking of? First of all, I think that we should focus very much on having a strong retail investors. And this depends to me on three elements. First of all, high financial literacy levels. Second, simple investment products. And finally, we should also aim at having tax incentives. So this is something, for instance, that currently takes place in Sweden. We have a very good example, the ISK account, which is really successful. So more than 27% of Swedish GDP can be found in that ISK account. And this is not only due to tax incentives, but also to a very simple administrative and way of very simple administration, I would say. So that's one side of the story. The other side of the story is having strong institutional investors. And again, we see that it's Nordic member states, the ones where pension funds are way more developed. And we see also how this is very much related not only to capital markets development, but also very much related to fiscal sustainability, because developing Pillar 2 pension systems with auto-enrollment, for instance, as is the case in the Netherlands, not only allows for bigger institutional investors who can provide other sorts of funding to the economy, not only collateralized funding like banks do, but also it takes a lot of problems away from fiscal accounts. So basically, these two elements that I mentioned, retail investors, so financial literacy, tax incentives, plain investment products, and on the other side, having strong institutional investors, are something that depend on member states. So one of the issues, I think one of the main confusions when having a look at the Draghi report is that many member states and many citizens believe that all the solutions should come from Brussels, and that's not the case. So if we think about what the Commission has done, for instance, with investment products or with Pillar 2, Pillar 3 pension systems, it's basically recommendations or some amendments to the PEP regulation when it comes to personal pension products or to IORP 2 when it comes to occupational pension products. But the final decision rests with member states. So member states are also very much responsible for taking forward Draghi recommendations. Of course, this doesn't mean that the EU has nothing to do. Of course, having a single market is very relevant. For instance, thinking about investment funds, about institutional investors, building on EFAMA data, we see that in the EU we have a scale problem. So basically, the average EU fund manages around 400 million euros in assets, vis-a-vis 2.7 billion euros in the case of the US. And this has implications in terms of fees. So fees of EU funds are higher than those of the EU, but of the US, but basically because they cannot really benefit from economies of scale. So we really need to build a single market, and that also takes me to the banking union. So usually, many times we think that it's the fault of Germany or the Netherlands or Finland that they don't want to make progress on the European Deposit Insurance Scheme. But if we think about the second pillar of the banking union, which is the resolution pillar, we don't have a common backstop to the Single Resolution Fund because Italy hasn't ratified yet the Treaty of the European Stability Mechanism. So it's not the same the usual suspects that also play a role in a lack of progress in the banking union. And also, now we are talking again about a merger operation between a big Italian bank and a big German bank. Again, we see also economic nationalism looming in member states. So I am going to leave it here. I think that it's not only the fault of the EU. If we're talking about a lack of progress, it's not only for the European Commission. We also need to have a look at capitals, and capitals should also be accountable for the current situation. Thank you.
Thank you very much, Judith, for this great overview. Daniel, let's turn to you now. The floor is yours.
Thanks a lot, and it's a pleasure to be here and to follow Judith. I thought I can make it more interesting by saying that from the outside, I fundamentally disagree with what Judith mentioned at the very beginning, but I fundamentally agree with most of her policy recommendations. And if I take the Draghi report, I would put it the other way around. I fundamentally agree with the premise of the Draghi report, but then I cannot follow the recommendation at the very end to spend hundreds of billions. Now, why? And here I think something Judith already said. If one looks just over the last 20, 25 years, the EU has on average had the same, if not slightly higher, investment rate than the US. And we know it has had a lower growth rate. You put the two together, that means that the investment in capital in Europe has been less effective. So just from this observation, you should think, if I push more money through the same system, I get the same result, right? So I don't get great returns. Now, let me come more specifically why this lower rate of growth in Europe. And I think all analysis, and Draghi also concurs, in traditional industry, there's no difference between the US and Europe. But it's on the innovative part, where the US is much stronger. And here I want to refer to some research we have done, which is actually taken up in the Draghi report, where if one looks at the effort of research and development of different industries in Europe, one finds that industry in Europe spends mostly on developing what we call middle technologies, to be practical, automotive and machinery. Whereas in the US, the largest part of innovative effort goes to high tech, basically software, computers, chips. And we also know that these middle technology sectors, they grow at 1 to 2% per annum. Whereas the high-tech sectors grow at 10, 15, whatever. So that means if you have on one side of the Atlantic industries which invest mostly in known technologies, incremental innovation, they're going to grow less. That is just unavoidable. And here I come back to what I said at the beginning. If you give these industries more money to invest more, you will get the same outcome. Now, why do European industries stick to these old technologies, old or let's say medium tech sectors? I think one reason, not the only one, but one reason is what Judith mentioned or explained, namely that our system is bank-centric, and banks like to give credits for stuff, where they have a tangible security, a machine, right? Something tangible, a new building. And they don't like high-risk ventures because banks at most get their interest. And if it goes badly, they lose their capital. That is the difference, one key difference between the US and Europe. You need more sources for innovative ventures. And as you had mentioned, we need more VC capital, for example. Now, the question is, how do you get that? It doesn't come out of thin air. And some of the issues that were already mentioned, I agree with. And I also agree that a lot of the obstacles are at the member state level. If every member state had a nice second or third pillar in its pension system with big pension funds, that would be better, right? But that's up to member states. The Germans tried, by the way, 25 years ago. They said, oh, people, why don't you buy shares? And they did that just when there was the hype of the dot-com bubble. So people follow that advice, and just at that moment, boom, they lost their money, and therefore this has now a very bad name in Germany. Whereas the Nordics, the Swiss, the Dutch, they have done that for ages and have very good experience with that. So I agree there again with Drew that a lot of the responsibilities at the member state level. But there's one thing perhaps we could do at the EU level that might have an impact. And there I'm talking about an EU regulation called Solvency II, which concerns insurance, the insurance sector, and in what assets these insurance sectors can invest. And right now, if they invest in equity, heaven forbid, if they invest in risky equity, they are penalized a lot. Whereas in the US, pension funds can invest under so-called prudent man rule up to 2% of their assets in venture capital, which is very, very risky, but very high return if you take a long enough view. So my simple proposal is that is something we should do in Europe. Make it easier for our insurance companies to invest much more in equity, hopefully also in high-risk equity like venture capital. They're in the business of long-term investing, so they shouldn't give long-term credits. They should invest in long-term risky ventures. And I think that is one concrete step that we could do at the European level that should increase the supply of risk capital, and I think would foster our innovation system. We don't need hundreds of billions of money from governments. I think this is simple rule change that costs nothing. And that's all on my side.
Thank you so much, Daniel. Great presentation. Finally, I will pass the floor to Frederick for our final presentation before we move to the discussion.
All right. Thank you very much, Oscar, and also thank you to Judith and Daniel for two very good starting points for this discussion. I think I'm going to try to knit the different strands together a little bit with a couple of observations, both in terms of perhaps trying to deepen the understanding of some of the problems, at least, that Mario Draghi pointed to in his report, and then also try to take it back a little bit to a field where I think there is an opportunity also at the EU level to begin to change things in order to bring about a better type of economic development. So if we start with one piece of the Draghi report, which is more firm and sector specific, and that tries to distinguish where we have the problem, what he's doing is basically pointing to two sectors. It's ICT services and it's biotechnology, where largely we see a development in Europe which is not comparable to what we find, for instance, in the United States, but far from only in the United States. We see developments where Europe is also behaving differently over time, for instance, compared to more industry-oriented economies like Japan and South Korea, to mention just two. So these are two pretty strong frontier sectors in terms of driving innovation, and they also leave a comparably much higher contribution to GDP and productivity developments in other parts of the world than they do in Europe. And we can begin to disentangle that observation a bit and see how it connects to both a couple of upstream and downstream issues in the European economy. If we start with more of an upstream issue, I think it's interesting to consider a couple of observations around R&D and R&D performance between different sectors and between different economies. Draghi himself and many others, of course, have already pointed to the fact that there is a huge gap between the EU spending on R&D and the EU performance of R&D spending. If we just look at the total volumes and we go into R&D spending, which is specific to business, we will see that there is roughly a $350 billion gap between business R&D spending in America and in Europe. If we would take that as shares of GDP and we would compare Western European countries, for instance, with Japan or South Korea or Singapore or others, we can see that the gap is very significant. This is mostly not in industries. And I think this goes to Daniel's point, which is that when you look at the performance of different sectors, you're going to find that the innovative performance of European industries are roughly comparable with the innovative performance of the same sectors or the same industry in other parts of the world. This is something which is much specific to highly innovative sectors and also mostly in services. So when we look, for instance, at services R&D by businesses in Europe, they are vastly different from services R&D in, for instance, the US economy, but also vastly different from services R&D in, for instance, the UK economy. We also see that there are a huge gap between top-performing EU countries and top-performing countries elsewhere. So if you take countries like Sweden or Belgium or Austria, which top the league of R&D spending per capita or as share of GDP, you're going to find that they are pretty far behind top spending regions in the world when it comes to R&D. Top spending countries in the world when it comes to R&D spending. And we find the same pattern also when we look at differences between regions. So if you take, for instance, Baden-Württemberg, which is the most R&D intensive region in Europe, and you compare it to the most R&D intensive region in South Korea or Japan or America, you're going to find that there are vast differences in levels of spending. Now, the question, of course, here is that what explains this, what it's all about. And I think this also goes to Daniel's point on industry structure and how Europe has ended up in a sort of a middle technology trap, because the main explanation for why we have these huge differences is that we don't have an industry structure that easily conforms to a macroeconomic pattern where you're going to find more input spending for innovative activities, or that you're going to find the typical performances that you also see on different output metrics for innovative sectors. There are a few differences still that may be important to point to. For instance, that we find that SMEs in other countries in traditional industries can have a higher R&D intensity than they traditionally have in Western European countries. So if you look, for instance, at the SME performance of many smaller auto companies in South Korea, you're going to find that they have higher R&D intensities than the similar companies in Western Europe. And obviously, some of this also spills over to different downstream gaps that exist, for instance, in patent activity between sectors and firms when you compare them across countries, or different innovation metrics as well. So that is the first innovation, sort of first observation, which is more upstream, that I think could be of interest to also think about from a policy standpoint, because it's not as if there is a gap here in terms of government spending on R&D. It's a business spending R&D issue, and we need to try to figure out how we can compensate for that across Europe. Again, this is not necessarily an EU policy, but it's a policy that I think many member states will have to work with, as we need to find ways to channel more sort of investments, more R&D to go into sectors in Europe where they do tend to have a higher economic payoff than in middle technology sectors. My second point going to be on regulation, and also how regulations may have the impact of deterring the type of change in the industry structure that we ideally would like to see in Europe in order to grow our economic performance and our innovation activity. So what's notable is that both biotech and ICT have seen an enormous growth in regulation in the past 10 to 15 years. They have also seen a very fast growth in what we can say the complexity of regulation, that we have regulations that are difficult to understand, to implement, and to work with from the viewpoint of different firms, at the same time as we have regulatory divergence across the world, which at least allows for many companies to reallocate activities between parts of the world in order to locate them in places where the regulatory environment is more conducive to the type of growth that we like to see. I mean, famously, we have seen, for instance, in biotech, companies like BASF and others that have closed down different R&D sectors or in R&D units and moved them elsewhere to countries like America and China and other parts of Asia, because the regulatory environment wasn't conducive enough in Europe. In ICT services more broadly, we have, of course, seen an explosion of regulation in the past 10 to 15 years, basically starting with GDPR and going forward from there. And three things which are a bit problematic with these type of regulations and the complexity of them is that they do come at a time where, as an economist, I would say what Europe needs to do right now in this type of technological shift that we find ourselves in is to start generate as much business-focused endowments in the economy as possible. And if Europe at that time is going to have a regulatory environment or an impulse in regulation, which is that we're going to regulate faster, harder, and deeper than any other part of the world that we can compare ourselves with, the risk is that we're going to find an endowment creation in our economy, which is going to be much slower than it is in other economies. And this has been pointed out time and again in the case of GDPR, for instance, that many of the data endowments that now help to power much of the competitive performance of the economies have been a lot slower in Europe after GDPR than they have been elsewhere. A second problem in this field is also that we have a lot of regulatory conflicts, that we have one regulation that mandates or instructs one certain behavior, which is conflicted by the mandates or the instructions that come in a different regulation. And this, of course, has been also famously been pointed out over the past couple of years when, for instance, ICT services companies and platforms have not introduced different services in Europe because of regulatory conflicts and the risk that they get mandated to act in a certain way, which forces them to basically violate regulation in another field. This is not an uncommon problem, and we've seen it also in America in other sectors, which is that you basically get to a point where you have to violate one regulation in order to comply with a different regulation, and that's not good at all. And thirdly, is around different downstream development effects and different downstream use that comes from these type of regulations. I've keep a tracker of different companies that I heard of, European companies that have decided not to do things in Europe because of the AI Act. And my own tracker, which is basically most on personal contacts I've had with entrepreneurs and companies now, adds up to 74. And these are usually smaller type of companies that wants to develop things that may or may not in the future bump into the AI Act, but they don't know. And it's very difficult for them to find out the extent to which there is a regulatory risks. And as a result of that, they have forced to do things here, or they have moved things over to other countries. I've talking, for instance, to one, again, Swedish AI company that has been working on an AI to avoid falling accidents for elderly people, in which they need to use biometric data. And they stopped what they were doing in Sweden and moved over to Japan and started to do things there instead. We see, for instance, Volkswagen having problems with both GDPR and the AI Act because leading to much higher development costs for them in data-related issues compared to what they can do elsewhere. I know, for instance, Europe is a very strong competitor in trucks, in heavy vehicles. But all the major three companies that are leading globally on these issues are developing all their autonomous solutions for logistics in the future in Canada and the United States because of difficulties of doing it here, since they don't know the extent to which they are close to a regulatory risks when they do that. So I'm going to end on that note and hand over to you, Oscar, but just to say sort of that I think there is a regulatory agenda here where we can begin to think in Europe what we need to do in order to provide for also an environment where you're not at risk of, or at least we're not encouraging emigration of entrepreneurial activity because we don't know whether we are in compliance or in conflict with the regulation. Thank you.
Well, thank you very much, Frederick. That was not just a presentation, it was a tour de force, although we finished with a slightly pessimistic note, but let's move that we have heard from the three of you, and now let's have a panel discussion, and the questions are going to be oriented towards solution, or towards kind of what can we do, and let's start the discussion with you, Judith. And this is a question that connects your presentation, but also some of Daniel's points. European households' wealth is tied up in real estate and bank deposits. You have said that, you have explained that, and put the data on it. So my question to you, what is the single most effective policy change that we can do to shift consumer behavior towards market-based investments?
Thank you very much, Oscar. Before answering your question, if I may react to some of the points just made by Fred, may I do so?
Absolutely. I didn't want to put anyone on the spot, but I was thinking that, yes, by all means.
No, thank you. No. The issue is that I agree with everything he said. So heterogeneity, I mean, of course, there was a question in the chat about the single market, like the single market being the solution, making reference to the letter report. Of course, I fully agree that the single market is part of the solution, but also to build a sustainable single market, we should have comparable pieces. And if we have a look at the different elements that are behind what one could name competitiveness, like ICT talent, access to alternative funding sources, energy costs, R&D spending, both by the business sector, private sector. We see a lot of heterogeneity across the EU member states, but we also see a lot of regularity, meaning that usually it's the same member states, the ones which are at the top of the ranking, and usually it's the same member states which are below average. So this means that we should not only think about the Draghi report for the EU level, there should also be a Draghi report for those member states below EU average. There's no need, in my view, to look at the other side of the Atlantic. So we have very good examples inside of the EU of member states who are doing things right. So I think that that should also be done at member state level, and I think that it's a very relevant element. Second point, I don't think that the EU has an innovation problem. So if we have a look at the number of startups, they're there. If we have a look at patents, we rank very high. The problem is of scaling up, and this is again very much linked to the internal market. I fully agree with this, and we see some sort of cherry picking also from the other side of the Atlantic, like the US attracting our best startups when they're in the phase of a scaling up, because they can provide better suited funding, which we don't have, just as Daniel was saying, for instance, in terms of venture capital. So I think that this phase of scaling up is a critical moment for innovation in the EU. Third point, regulation that Frederick brought to the table. I mean, I'm very much in favor of simplifying regulation. I think that we have super complex regulation, not only at level 1, but also at level 2, level 3 in the case of the financial sector, also in level 2 in other types of regulation. But if I think about the simplification exercise that we have kickstarted in the EU, I have doubts that we're going down the right path. So, for instance, I'm thinking about the Omnibus 1, the sustainability omnibus, where basically simplification has consisted of massively reducing the scope of application. So those firms, those companies that were already preparing to comply with sustainability directives, suddenly they see that even if these directives were approved very recently, they no longer need to comply. And that's not really simplifying, that's simply backtracking from our previous policy objectives. So, and this has been done without even a proper impact assessment by the European Commission, in a moment where basically there's a claim for the Council and the Parliament to also run impact assessments on the amendments they introduced, to which I fully agree. But if we are talking about better regulation, then maybe starting the simplification exercise by what we've done with the sustainability omnibus, maybe it's not the best possible beginning. This being said, I'm way more optimistic about the digital omnibus. I welcome very much some of the amendments suggested for especially GDPR. And to the point that Frederick was making, I think that it's not only a matter of complex regulation, it's also a matter of governance. So if we think, for instance, about the AI Act and who will be the national market surveillance authorities, there are member states where there are more than 6 national market surveillance authorities. So already with the GDPR, this led to a lot of heterogeneity because we had national data protection authorities. In the case of Germany, even each land had their own protection authority. But in the case of the AI Act, this will be exacerbated because of very different AI authorities being in charge of this at national level. So it's not only a matter of regulation, but also of how this regulation is enforced and how governance is taken forward. And now to your very interesting question. I mean, I wish I had a silver bullet. This type of question that you raised, I really like it. And it's a kind of question I usually raise. So I'll try to give you an answer. If I had to choose, I'd go for occupational pension funds. So for Pillar 2, pensions for an auto-enrollment system. And I'm going to explain to you why. So as we mentioned in the previous round, basically this is mainly a national prerogative. So this means, for instance, in the case of my home country, in Spain, public authorities have decided to almost kill Pillar 3 pensions. So you can only contribute in Spain every year 1,500 euros to a personal pension product. It's not only that that amount is tax incentivized, it's that you cannot contribute more than 1,500 euros. So you would need 100 years to be able to contribute with 150,000 euros. Basically, the idea has been to try to promote occupational pension funds, so Pillar 2, still not very successfully, but still it looks like there's a clear bet for occupational pension funds. So I think that would allow us to, on the first hand, have stronger institutional investors with stronger capital markets, providing other types of funding to innovative companies that banks are not in a position to provide with. And in this regard, so Daniel mentioned Solvency II for insurance. I'm going to mention the review of IORP 2 directive, where the prudent person principle is being reviewed, and where in principle the universe of eligible assets will be increased. So I would welcome this very much. So to me, occupational pension funds kill several birds with one stone. So capital market development, providing funding to innovative companies, and also fiscal sustainability and draining pressure from Pillar 2 pension systems. And I leave it here. Thank you.
Thank you very much, Judith. I do agree with you that for our country, Spain, tackling pensions and the real estate are the two big challenges, and they are intertwined. And life expectancy in Spain is high, but not yet 1,000 years. So we need solutions, right? Before I turn to Daniel and Frederick for the other set of questions, I don't know if you guys want to react to Judith comments, or maybe in the case of you, Daniel, if you want to react to the other panelists' presentation.
Well, just a first comment to say you have a problem here that we mostly agree. I agree that occupational pension systems would be very nice to have, especially also in Germany, the country I know best. As I said earlier, they tried once in Germany, but they picked the possibly worst moment they could have picked in almost 40 years. But let me add something to what Frederick said, which I think is very true. On the regulation, in Europe, our regulation operates basically on the principle that you have to show first that something new you are doing doesn't create a danger for anybody else. And with new stuff, that is, of course, difficult, right? Whereas in the US, the approach is more, okay, if you do something and you break somebody else's leg or whatever, then you pay very high compensation. So I think our regulation with that kind of principles, and the AI Act, I think, is one of these examples, is of course leading to that result that new, if you want to do something new that might involve some data, might involve some AI, you're not quite sure, then you say, and then I better do it somewhere else. And on top of that, and I think Judith and both Fredrik also mentioned, both Judith and Fredrik mentioned that, I become technical now. We think that when we have a regulation in Europe, then things are okay and they will be the same everywhere. It is true that the same law will apply everywhere, which is different for a directive where every country can make its own law, which might then add to what the EU had in mind. But the problem is in supervision, implementation, and interpretation. And since I was doing a lot of work in the financial sector, Judith also knows that the big problem we had in the running up to the financial crisis was that maybe we had a common rule book, but we had different national supervisors, which interpreted that rule book usually in a different way. Basically, for the banks, they said what our banks are doing is okay, but foreign banks are doing, we have to look twice. So I think that is an additional complexity which has to be kept in mind. If then I look at the letter report, there in some areas where we have regulation, I think it is excessive. I agree there, but at least we could perhaps improve a little bit if you were to have a common European supervisor. So you don't have in every country different offices, different institutions that interpret this common European law in a very different way. And in a fast-moving area like high tech, it's no use to say, okay, then you go to a European court in Luxembourg and complain about differential implementation. When you win your case 5 years later, you're out of business. So I think not only should we rethink our regulation, I totally agree that just the omnibuses that we have seen so far are more populist gestures than resolving and making a simplification. On top of that, we should think perhaps of in strategic areas having European supervisors that ensure consistency throughout the Union.
Very good. So if I may, and then I kind of carry on with the questions, at least Fredrik, you want to react now?
No, perhaps I'm just going to make a gloating point more towards bad incentives for retirement savings in Spain. But I know a lot of fellow Swedes who are looking forward to the retirement because they're never going to have as good incomes as when they retire.
And they can also gain a few years of life expectancies there. So let's have the question, Daniel, for you. When you have this great paper about middle technology trap, and you have been presenting some of the ideas of that paper. And when we think about EU's competitiveness, I think we always kind of we also think about the US as a benchmark, and this could be also because the US has deep capital markets, which the presentation which you did, has lighter regulation, the presentation from Fredrik, and it also has, I think, a stronger single market. So my question to you, Daniel, is that are there any elements on the US that we can learn, that we can copy paste, or when you think about how to escape the middle technology trap, are we thinking about having a European recipe for it?
I think there are European recipes, plural. And I forgot now whether Fredrik or Judith mentioned it. We have in Europe a number of countries that outperform in terms of investment in R&D, growth, high tech, and so. And it's almost the same usual suspects. And these countries also have, I don't know, maybe by coincidence, strong pension systems with strong demand for equity. So it seems to be going together. It doesn't require to adopt a wholesale US model. I mean, Switzerland also is very successful, very orderly. I leave Fredrik to talk about or gloat about Sweden. They can retire in Spain with their savings, or now get actually a cheaper pension when they retire in Portugal. Sorry, lower taxes when they retire in Portugal. So no, I don't think we need to imitate the US. We already have very strong systems in Europe. And actually, one further element we haven't talked about the successful European countries, which is strong pension systems, institutional investors in equity, and therefore one leg that is important, the financing of. They also have very strong universities. Compared to on a per capita basis, if you look at Sweden, Holland, even Belgium, Switzerland, they have per capita many more world-beating universities. And some research we are doing shows that actually that's where most of the venture capital goes. And I think, Fredrik, you mentioned biotech. You also have done some research on that sector. And you see Switzerland, which is extraordinarily successful in that sector. And the Swiss don't have the US model, right? And that, I think, is something we can, again, have to at the European level. When we think about European expenditure on our support for R&D, Horizon programs, there's a tendency to spread the money as much as possible, right? And when you give money, especially in what's called the Pillar 2, you have to be a consortia with 20 people, east, west, north, south, small company, big company, right? And then in the end, everybody gets a little bit. We have some very high-performing EU programs, which is called the European Research Council. The money goes to one person, and it is that person or that project is selected only on excellence, not whether it's east, west, north, south, or whatever. And these are the parts we need to strengthen. We need to allow for more diversity and allow the best ones to succeed, not only in industry, but also in research, which is then the basis for future innovation.
Very good. Thank you, Daniel, for your answer, which also chimes with some of the work we have also done at ECIPE. So now let's turn to Fredrik for our next question. It's kind of it's interesting, funny, a bit frustrating that when all the kind of the three of you you have been discussing that the issues in terms of European industrial competitiveness lie in services in high tech. But now Brussels has been occupied by, state aid of big industrials, made in Europe policies, the Acceleration Industrial Act, who wants to increase the percentage of value added of industry, which in a way is ignoring Europe's technology problem. And you, Fredrik, you have kind of linked Europe's technology problem to the issue of modern endowments, data in particular, and you have also talked about how regulation in Europe makes access to those endowments like data more costly and make data artificially scarce. So if you were kind of the head of the dictator for a day, let's say, and talking of you have the list of EU regulations that are constraining Europe's technology development and diffusion. Which EU regulation should be the first to go and why?
Well, I mean, it's a difficult question to answer. I mean, it's a good question you raise, Oscar, but I think it's a bit difficult to answer as well, because I think, in the first place, I think there are a good motivation that you can give for at least pausing some of the regulatory seal that we've seen in Europe. And right now, the most obvious one is the AI Act. And it's a strange regulation in the sense that when you think about AI is not a product. It's not a specific service necessarily. It's a value chain of different type of inputs of different type of, it could be everything from data to algorithms to software to data management infrastructure services, a host of different things. And you begin to look through the regulations that already cover different elements of what constitute AI. We're talking about 45 EU regulations that already govern different aspects of the value chain of AI. So the AI Act is one of those strange beasts where you try to add something on top without understanding that there are already a big stream of regulations that affects the entire value chain, which also impacts what the end product is going to be. So, but I would think this is a good candidate for at least pausing it for a while and then return to see what the actual need for an additional regulation is going to be. This is basically what also famously the author of the AI Act has said after he left the commission and went to MIT, that it wasn't really any need for an act like this. We had a couple of gaps in EU regulations and in court decisions that we needed to fill in, but not necessarily through a very widespread regulation. But my point otherwise is that we need to find both a more pragmatic attitude to regulation when we decide to regulate in Europe, and that we then need to find a form of application of the regulation which is more uniform in Europe, which goes to the point that both Judith and Daniel has made about the fragmentation we get when we have lots of different implementing authorities that will implement things in very, very different ways. I mean, this has been pointed out time and again in case of GDPR. If you wanted to do things which were highly sensitive for GDPR covered aspect, you really didn't want to do that in Germany because it was German data protection authorities you need to deal with. But if you do it in Ireland or in Sweden or in the Netherlands, you were actually you were meeting a data protection authorities that defined not just its role as enforcing a regulation, but also helping companies to comply with the regulation in order to tell them how they could structure things in order to avoid that they were going to violate GDPR. But if we take a couple of other things that I find interesting is to sort of get inspiration from the countries in Europe that are doing well. I think that's a very good point, but also getting inspiration from countries in the world that are doing things well. And if we look at the broad data economy more widely, I think countries like Japan and South Korea are pretty good places to go in order to find inspiration for both how you can have a regulatory ambitions that may be different from the one that exists in America, but where you structure it in ways which is a bit more pragmatic and allow for less of an extreme application of it. If you take, I mean, just before Christmas, Japan started to implement its new equivalent of what we would call a Digital Markets Act. And it's basically the same thing if you look at the objectives that this act, as we've had in Europe, but it's just that it takes more of a pragmatic attitude to different things to avoid that you get to these points where if there is a risk that you will violate another regulation in order to comply with what they have, they're not going to insist on a particular solution which is going to lead to just very extreme outcomes. So looking at these type of countries and finding inspiration for how to design regulation, I think is a good way. And I say this because we have taken pride in Europe of being good regulators for a long period of time. And when I started to work on EU affairs 20 years ago, that was also one of my experiences, that when I came across officials, units, different actors that were involved in regulation, I did find them to be very, very competent and to apply a mindset of pragmatism as well as finding constructive solution in order to build a single market that usually did things well. Now I fear we are not at all comparable with other countries in the world when it comes to having a good design of regulations that is going to motivate the type of activities that we actually want to see, because it conforms to economic development and broader societal objectives we have. We've got stuck in a type of regulation which is just not helpful.
Very good. Daniel, Judith, I don't know if you have a reaction to the other questions, if you want to have a final comment before we close.
No, thank you so much. I just want to say that we all agree very much, and we come from very different member states. So Fredrik comes from Sweden, Daniel comes from Germany and is based in Italy. I come from Spain. So it means something that coming from very different member states, we are launching, I think, the same messages, the same kind of message. I find this inspiring and also positive. Thank you.
Great. Sorry, Daniel.
Let me just add one, if you want, data point, which is Japan. Japan has invested, or if you look at the Japanese data, you see that investment in R&D in Japan has been constantly above 3%. The target the EU wants to achieve or wanted to achieve for 20 years. But Japan is nowhere. Most of the investment in R&D in Japan is done by the big corporations in incremental innovations, which means that they're always staying in their own sectors. The Japanese were the kings of consumer electronics. Maybe you remember the VCR, video cassette recorder, the Walkman. It's all done by the smartphone now. And so, but what is astonishing is that they haven't changed, right? And if you look actually at VC capital funding, you see that there are some VC funds in Japan, but less than 1% of the global total goes towards projects in Japan. So there's extremely little innovative activity from the bottom up. And I come back to my very initial point. It's not about the quantity of money. It's how much R&D takes, right? Our own goal of 3%. That's not the key. That should not be the goal. The goal should be to create the conditions, the framework conditions that Judy mentioned, that Fredrik mentioned, right? In terms of regulation, financial markets, and so on, that actually then induces companies to go into these innovative sectors. So Brussels should stop talking about hundreds of billions. It should stop talking about providing support for existing industries, but concentrate more of making life easier for those who want to build the new stuff.
Great. That your final comment made me look in the web. The famous quote, not sure if it's for him or not, from Einstein, that insanity is doing the same thing over and over and again and expecting different results. It's nice to end up with the words from Judith that there is an agreement, and seems to be there is an agreement that we also need change, and we need to think about doing things differently, and focus on new sectors and the sectors which are growing and where technology is emerging. Fredrik, do you have a final word before we close?
No, just to say thank you, and also to say I think it's indicative, and I find this, of course, like others, inspiring, that we do think there is a very, very good and obvious way forward. I think the difference is just sort of between more of a perhaps that we have a political problem, in the sense that we have lots of politicians, not just in Brussels, which have convinced themselves that our main challenge is to develop basic industries more in the future, not to trying to incentivize investments, entrepreneurial activity to go into new and create new things. And that, because I mean, that is, of course, where growth is going to come in the future.
Great. So that brings us to the end of our time today. Thank you to our wonderful panelists. Thank you, Judith. Thank you, Daniel. Thank you, Frederick. And thank you to everyone who is watching us. It's been a great webinar on a crucial topic to Europe. And for our viewers, we'll see each other at the next ECIPE webinar. Goodbye.
Thank you very much. Bye.